When you're just starting out, the most dangerous illusion is that complexity equals intelligence, that if something sounds advanced, it must be better, that the more moving parts you add, the more powerful your system becomes. But in reality, complexity is often a mask, one that hides uncertainty, emotion, and poor understanding. Beginners who chase it usually don't realize they're adding variables they can't control and risks they can't see. Simplicity, by contrast, is clarity. It doesn't mean doing less, it means doing what works over and over again without the distractions of noise or novelty. And in the beginning, simplicity gives you what complexity never can: consistency. That's the foundation of all meaningful compounding. Without consistency, time doesn't work and your favorite works against you. This applies especially to investing. When you're a beginner, you don't know what you don't know. And pretending you do, by jumping into sector-specific funds, timing trades, betting on leveraged ETF, or trying to interpret macroeconomic cycles with limited context, is like handing the steering wheel to emotion and hoping reason will keep you on the road. It won't. Complexity invites you to react, and reactions in markets are usually expensive. A simple, well-balanced ETF portfolio offers something deeply powerful. It removes your need to be right in the short term. It acknowledges that you're not smarter than the market, and you don't need to be. It's designed not to impress anyone, but to protect you from the most common cause of failure, your own behavior. And ironically, by avoiding complexity, you often outperform those who think their knowledge entitles them to better returns. Because they're managing ego, you're managing risk. There's another hidden truth beginners often miss. The more complex your system, the more maintenance it requires. That means more decisions, more tweaks, more temptation to intervene, and every decision you make is a chance to make a mistake. Simplicity minimizes those decisions. It turns your investment strategy into a system that works even when you're not paying attention. That's not laziness, that's design. Look at the most successful long-term investors. What you'll find isn't a list of genius-level predictions. You'll find discipline, you'll find structure. You'll find systems that are resilient, not because they chase what's new, but because they stick with what's proven. That's what simple strategies do. They free you from needing perfect timing, from reacting to news cycles, and from making emotional moves based on fear or greed. If you simplify early, you create space to learn. You develop habits around process instead of performance. You build a relationship with the market based on understanding, not hope. And most importantly, you protect your downside. Because early losses aren't just financial, they're psychological. They can break your trust in the system before you've even given it time to work. Simplicity shields you from that disillusionment. The truth is, beginners don't fail because they chose the wrong ETF. They fail because they built a fragile system, one that looked clever but couldn't withstand volatility. And that's what complexity often leads to: fragility. It looks like strength right up until it breaks. So the best thing you can do at the beginning isn't to try to outsmart the market. It's to build something that can't be easily broken, something simple, something stable, something that works even when you don't. That's not underthinking, that's wisdom, and in the long run it wins. Most people misunderstand risk. They think it's about volatility, whether an asset goes up or down in a given week or month or even year. But real risk is deeper. It's the permanent loss of capital. It's being overexposed to the wrong force at the wrong time, and it's almost always the result of poor balance. What protects you isn't prediction. It's preparation, and the single most effective form of preparation is diversification. Diversification works because it acknowledges a fundamental truth The future is unknowable. You can have educated guesses, sound frameworks, historical patterns, but none of them eliminate uncertainty. The world changes, economies shift, governments intervene, technology disrupts, cycles evolve, no model captures everything. So instead of trying to outguess reality, you build a portfolio that doesn't require you to. The power of diversification isn't just in reducing risk, it's in improving the quality of returns. When done right, it creates a smoother ride. It allows compounding to work more consistently. It cushions you during downturns so you don't get emotionally shaken out. And over time, that stability adds up. Because what hurts most investors isn't a single bad year. It's the bad decision that follows that year. Diversification doesn't prevent loss entirely, but it minimizes the kind of losses that lead to panic. And it goes far beyond just owning multiple stocks. True diversification means spreading your exposure across different asset classes, equities, bonds, commodities, and potentially real estate or cash. It means understanding that each asset performs differently under different economic conditions. Some thrive in growth, some protect during contraction, some respond to inflation, others to deflation. When one zigzags, another steadies. That interaction is where the real value lies. It also means diversifying geographically. No single country has a monopoly on innovation, productivity, or resilience. Economic leadership shifts, currency regimes evolve, political risk fluctuates. Putting all your capital in one economy, even if it's historically dominant, is a bet, a concentrated one. Global diversification spreads that risk. It gives you access to different cycles, different demographics, and different drivers of growth. The irony is that the more certain someone feels about the future, the more they resist diversification. They believe they've found the one asset or the right moment, but markets are humbling. The things people feel most certain about are often already priced in. The surprise doesn't come from what's expected, it comes from what's not. Diversification protects you from the unknown unknowns. It also forces you to detach from narratives. When you hold a broad range of assets, you don't need any single one to carry the weight. You don't need to cheer for a specific outcome. You become less reactive, more neutral. That neutrality helps you stick to your strategy, and sticking to your strategy, especially during the painful periods, is one of the most underappreciated advantages in investing. At its core, diversification is not just about risk management. It's about respect for uncertainty, for complexity, for the things we can't control. It's a recognition that ego has no place in portfolio construction. That discipline beats conviction. That resilience matters more than brilliance. You don't win by making the perfect bet. You win by staying in the game. Over decades, the best performing portfolios weren't the flashiest. They weren't built on bold predictions. They were built on balance. And balance doesn't happen by accident. It's engineered. Diversification is that engineering, quiet, thoughtful, powerful, and always working in the background, whether you notice it or not. When most people enter the markets, they're thinking in terms of winners and losers. They pick a company, believe in its story, follow its news, track its earnings, and hope. But investing that way is like betting on a single player in a chess match without understanding the board. The market doesn't reward belief in a company. It rewards positioning within a system. And if you ignore the system, even the right company can lead to the wrong result. Every stock is a piece of a much larger mechanism, driven by debt cycles, productivity shifts, monetary policy, demographics, global trade flows, and technological change. These forces are invisible to the average retail investor. They move slowly, quietly, and often in ways that contradict the narratives in the headlines, but over time, they're what actually shape returns. The individual stock is just a vessel. The system is the current. And if you're swimming against the current, it doesn't matter how fast you paddle. Positioning means understanding where we are in the larger cycle. Are we in an environment of tightening or easing, inflation or disinflation, growth or stagnation? These conditions determine which types of assets thrive and which ones struggle. If interest rates are rising, for instance, growth stocks may suffer, not because the companies failed, but because their future cash flows are being discounted more heavily. That has nothing to do with the business and everything to do with the environment. That's why smart investors don't anchor to companies. They anchor to principles. They don't ask, what will go up? They ask, what's likely to perform well in this environment? And more importantly, what positions give me balance regardless of the environment? The goal isn't to be right. The goal is to not be overly wrong in any particular scenario, because you won't always see the shifts coming. Even the most prepared get blindsided. So the way you build resilience is through positioning, not prediction. ETF offer a practical way to do this. They're not vehicles for betting on individual brilliance. They're structures for systemic exposure. A broad market ETF isn't about picking the winners. It's about owning the system that selects winners over time. The economy grows, productivity improves, capital flows to efficient outcomes. A well-structured ETF captures that evolution. It doesn't need to outsmart it, and the same logic applies globally. When you own an international or emerging markets ETF, you're not placing a wager on a specific country. You're allocating capital to where growth and innovation are unfolding. You're participating in the movement of wealth, labor, and technology across borders. You're building exposure to different political systems, different monetary regimes, different cycles, so that when one part of the world slows, another may rise. This kind of positioning takes the pressure off being right. You no longer need to guess which company will outperform this quarter, or which industry will rally next year. You're operating from a higher altitude. You're constructing a portfolio that mirrors how the world actually works, not how you wish it would. That's the discipline that separates investing from gambling. It's not about hunches. It's about alignment with reality. The more you position yourself within the system across asset classes, geographies, and cycles, the less exposed you are to any single point of failure, and in the long run, that matters far more than the occasional big win. Because true investing success isn't about picking stocks. It's about building systems that can survive the unknown and still compound over time. Emotion is the silent killer in investing. It doesn't show up in charts or models, but it's there under every impulsive buy, every panic-driven sell, every abandoned plan. It's what turns temporary drawdowns into permanent losses. The greatest enemy of consistent returns isn't the market. It's the investor's reaction to the market, and unless that emotion is removed, or at least minimized, it will show up again and again, sabotaging long-term performance under the disguise of intuition or caution. This is where automation becomes essential, not as a luxury, but as a necessity, because automation is what removes the investor from the emotional moment. It builds discipline where discipline would otherwise crack. When you automate a strategy, whether it's dollar, cost averaging into broad ETF, rebalancing quarterly, or allocating across uncorrelated assets, you are surrendering control in the short term to protect control over the long term. And ironically, that surrender is what gives you real power. The most dangerous time for an investor is not when markets are down. It's when fear and uncertainty cloud judgment and emotion takes over the process. Automation ensures that decisions are made without the fog, without the hesitation, without the desperate need to do something. And most of the time, doing something is the problem. Markets are designed to test your resolve. Headlines are built to trigger reactions. Prices move not because value has changed, but because sentiment has shifted. And if you're participating in that sentiment, you're already playing the wrong game. Emotionally driven decisions often come from the illusion of control. The belief that this time is different, or I know what's coming, tempts people to override their plan. But investing isn't about reacting to what's happening. It's about sticking to a strategy that was built before the emotion hit. That's what automation protects. It guards the integrity of the original process. The part of you that wasn't afraid, the version of you that built the plan in rational conditions, and this isn't just about downside. Greed is just as damaging as fear. In bull markets, automation tempers the temptation to overexpose. It reminds you that risk hasn't disappeared, only been forgotten. It enforces rules like rebalancing, selling what's gone up, buying what's lagged, not because you feel like it, but because the system demands it. Without that, people get sucked into performance-chasing, narrative-driven decisions or doubling down when they should be stepping back. The advantage of automation is not just emotional protection, it's consistency. Markets are unpredictable, but behavior doesn't have to be. A consistent process is the foundation of any compounding strategy, because in investing, small, repeated mistakes aren't just additive, they're exponential in their damage. A few poor decisions at the wrong time can erase years of gains. Automation helps eliminate those unforced errors. It also frees up mental space. Instead of constantly monitoring, questioning, adjusting, you focus on learning. You observe markets without being emotionally entangled. You develop a broader perspective because you're not trapped in the day-to-day volatility. That shift from reactive to reflective is where real growth happens. Automation doesn't mean passivity. It means designing a strategy that works without constant interference. It means trusting the system you've built more than the mood you're in. And it means recognizing that discipline doesn't come from willpower, it comes from structure. In the end, the most successful investors aren't the ones with the best forecasts. They're the ones who make the fewest emotional mistakes. Automation isn't just a tool, it's a shield against yourself, against the noise, against the temptation to abandon what works in pursuit of what feels urgent. Because in the long run, emotion is expensive, and automation is how you stop paying the price. Most people want excitement when they start investing. They look for the stock that will explode, the sector that's about to boom, the shortcut that makes them feel ahead of the game, and in doing so, they miss the point entirely. Investing isn't supposed to be thrilling. It's supposed to be structural, and the foundation of that structure is built on vehicles that don't depend on luck, timing, or storylines. The right ETF aren't lottery tickets, they're foundation stones. The purpose of a strong foundation isn't to impress, it's to endure. These ETF are built for resilience, not headlines. They are broad, balanced, and boring to the untrained eye. But that's precisely why they work. They don't rely on market timing. They don't collapse under volatility. They don't demand constant management or prediction. They're designed to capture the productivity of an economy, the growth of global systems, and the stabilizing force of counterbalancing assets. When you invest in something like a total market ETF, you're not making a bet on a single company or even a specific industry. You're aligning yourself with the productive engine of the economy itself. As businesses innovate, scale, and generate value, you gain exposure to that process, not because you found the next winner, but because you're already positioned in the system that finds them for you. That ETF adjusts, it rotates, it rebalances automatically, without emotion, without needing your opinion. Now contrast that with a lottery mindset. The lottery mindset chases what's already moved. It focuses on narratives, not fundamentals. It tries to outpace the market by outguessing it. But markets don't reward emotion, they reward structure, and these foundational ETF reflect that structure. They don't look for surprises. They look for participation in long-term compounding growth. The same logic applies to international or emerging market ETF. These aren't exotic plays. They're systemic exposures to where productivity and demographic expansion are taking place. The global economy isn't linear. Some regions rise as others slow. Currency regimes shift. Debt cycles unfold at different times in different places. A diversified global ETF doesn't try to pick the next breakout economy. It ensures you're not concentrated in only one. That balance is what preserves capital and captures growth at the same time. Then there's the stabilizing role of bond or inflation protected ETF. Most new investors overlook this part. It's not exciting. It's not what shows up on social media with flashy returns, but it plays a critical role. These instruments provide ballast. They behave differently in downturns, when equities fall, when uncertainty spikes, when liquidity dries up. These ETF hold the line. Not perfectly, but predictably. They give you the breathing room needed to avoid panicked selling and irrational decisions. And in a world where emotions destroy more wealth than recessions do, that's a vital advantage. What makes these three ETF powerful isn't just their individual characteristics. It's how they work together. They form a system, a diversified framework that adjusts across economic regimes, growth, inflation, contraction, and transition. They aren't dependent on you being right. They're designed so that even when you're wrong, you're not wiped out. That asymmetry, limited downside, stable exposure, and time on your side is what compounds into real wealth over decades. If you treat them like lottery tickets, you'll be disappointed. If you treat them like cornerstones, you'll build something that lasts, because investing is not about hope, it's about design, and the best designs aren't always loud. They're stable, quiet, effective. You don't need more trades. You need a stronger structure, and these ETF are the starting point, not for fast money, but for lasting outcomes. If you're just starting out, don't look for the next big stock. Look for the system that allows you to grow without needing to be right all the time. The three ETF I shared are not recommendations. They are reminders that the best way to start is to build something that doesn't need constant fixing. In the end, wealth isn't built by picking winners. It's built by avoiding ruin, and by staying in the game long enough for the compounding to do the work. Get the structure right now. Thank yourself later.